In recent years, a noticeable trend has emerged in the business world. Fewer companies are choosing to go public through initial public offerings, or IPOs. This shift has caught the attention of investors, entrepreneurs, and analysts alike. Traditionally, going public was seen as a milestone for a company, a way to raise capital, gain credibility, and offer liquidity to early investors. However, today, many successful companies are deliberately staying private for longer periods, sometimes indefinitely. In this video, we'll explore the key reasons behind this trend, why it's happening now, and what it means for the future of business. 1. The burden of regulation. Going public subjects a company to a multitude of regulations, financial reporting requirements, and governance rules. Laws like the Sarbanes-Oxley Act were introduced to protect investors and ensure transparency, but they come with significant costs and administrative burdens. For startups and mid-sized companies, maintaining compliance can be expensive, time-consuming, and divert attention from innovation and growth. Even companies with substantial resources often find themselves investing millions annually simply to meet regulatory obligations, making the IPO process less appealing. Pressure from shareholders and short-term expectations. Publicly traded companies face intense pressure from investors to deliver consistent quarterly earnings. This often forces management to focus on short-term performance metrics rather than long-term strategic goals. Entrepreneurs who prioritize sustainable growth and innovation may feel constrained by the constant scrutiny of shareholders and analysts. The tension between creating long-term value and satisfying short-term market expectations is a key reason many companies choose to stay private longer, maintaining the freedom to pursue bold, unconventional strategies. 3. The rise of private funding options. Private capital markets have grown tremendously in recent years. Venture capital and private equity firms are willing to invest large sums in promising companies, often without the need for an IPO. These private funds offer not only financial support, but also strategic guidance and access to networks that help companies scale. With ample private funding available, companies can remain private, continue growing at their own pace, and avoid the scrutiny and pressures of public markets. 4. Market volatility and risk management. The stock market is inherently volatile. Valuations can fluctuate dramatically based on investor sentiment, macroeconomic trends, or global events. For companies planning long-term strategies, this unpredictability can be risky. A company may be perfectly healthy and profitable, but still experience a declining stock price due to market swings beyond its control. Staying private allows management to focus on building sustainable business models without being influenced by short-term market noise. 5. Alternative exit strategies. Entrepreneurs today have more options than ever when it comes to exiting their businesses. Mergers and acquisitions provide liquidity and growth opportunities without going public. Additionally, special purpose acquisition companies, or SPACs, have emerged as an alternative route for companies to access public markets with fewer regulatory hurdles. These options offer flexibility and allow founders to maximize value while controlling timing, structure, and ownership more effectively than traditional IPOs. Conclusion: the landscape of corporate finance is evolving. Companies are no longer rushing to go public simply to raise capital or achieve prestige. Instead, they weigh the costs of regulation, market pressures, private funding opportunities, and alternative exit strategies. Understanding these dynamics is crucial for investors, entrepreneurs, and anyone interested in the modern business world. By staying informed, you can better navigate investment opportunities and appreciate the strategic decisions behind why many successful companies remain private today. The next time you hear that a tech giant or promising startup is delaying its IPO, remember, it's not a sign of weakness. It's a deliberate strategy, reflecting a deep understanding of market realities, long-term growth potential, and the advantages of staying private in a complex financial landscape.